Good afternoon. This is Tom Alexander. It is Saturday, December 16th. It is 3:15 p.m. Eastern Time in beautiful Charleston, South Carolina. And we have had an epic November and December so far in the US stock indices. And I guess some of the things we want to know are is this going to continue? Can it continue? What are our levels, and what is the internal condition of the market? First, let me remind you that this is typically a seasonally positive time of year. Now, I'm saying that in a market that is very extreme. I don't use the terms overbought and oversold because there's no such thing. There are, however, extremes, and extremes are relative to something else. And we'll talk about that in just a minute. By the way, if you find value in this video, I would very much appreciate it if you would subscribe to the channel, if you would like the video, and if you make comments, that would be very much appreciated. It helps the algo, and I will respond to all questions as promptly as possible. So let's dive into the charts here. And we're going to start, as we usually do, with the four primary U.S. cash indices, just basic bar charts. Now, I have done a little work. By the way, if you're finding me on YouTube, you can go to my website, alexandertrading.com, click on Weekend Update. It's free. You can see this report. You can see all the charts in this report. You can see the verbiage. You can study it. If I'm flying through something quickly and you want to revisit it, it's in written form on the website. You can download a PDF of the report if you choose. You can also access this video from the website if you choose. So alexandertrading.com, click on Weekend Update. It's free. Okay, so this is where we are. Now, let me explain the annotations on this chart. It's pretty simple stuff. There's no magic involved here. I do not use the dark sciences of Elliott Wave, Fibonacci, Gann, and 700 other dubious forms of analysis. I am strictly price-based. I want to know what price is doing. I want to know what it's done. I want to know what it did in the past. And I want to see if there's some sort of short-term analog. And that's really, to me, that's the most objective thing you can do. It's the most consistent thing you can do. And frankly, over time, I think you'll find it's the most effective thing you can do in terms of analysis and setting you up to make good trade decisions when you can identify the market condition that you're presently trading in. Right now, the market condition we're presently trading in all four of the indices, is in market profile parlance, auction market parlance, initiative development. It's a trend. It's a strong trend. There's no evidence at this point in time that the trend has stopped. You can only identify that it stopped in hindsight. So let's take a look at this. You can see here we are up from print low on October 27th to print high on Thursday of about 15.45%. The retracement so far from print high to print low against that trend have been 1.11% and 1.2%. They've been extraordinarily shallow and extraordinarily short-lived. Now we are a fraction, actually, we are 1.54% from an all-time high, which would be around 47.97, 47.98. If we were to take that out, that would represent a 16.76% advance from this low. I'm just trying to let you know what all these annotations are in this chart. Now, what I have done here, this is the classic three-step process in effect. So from the end of October into the first week in December, that's what we'll call leg one. Okay, and then we had balance, and we had leg two begin that lasted into the third week in November. Then we went into an 8-9 day balance area, and now we are in leg three. So over here to the left, I have highlighted the percentage gain of each of these legs. The first one was 6.46%. The second one was 4.84%. And the third one, the one that included the Fed ramp so far is 3.76%. Now, if we were to equal the first leg, which is the strongest leg in this particular, it's the strongest leg within the larger degree leg, then you're looking at 48.46. Okay. That would represent, let's see, what else do I have here? That would be about a 2.62% gain from Friday's close. So that's what all of these annotations represent. Again, you can go to the website, you can study this chart if you choose to. Now, something else I've done at the bottom of the screen is to add an element of time. Now, these are trade days, they're not calendar days. So from the end of October through Friday, we have 34 trade days. So the market is up 15.45% in 34 trade days. The legs have each lasted, respectively, the first leg 5 bars, the second leg 9 bars, and this particular leg 6 bars. So if the symmetry of this holds, what it would imply would be time-wise, another top buy Wednesday, and price-wise, something maybe between 47.97 and 48.46, if indeed it's going to go higher. Okay. So that's what all the annotations on this chart are. Now, you may ask yourself, okay, well, gee, what if you're wrong, Tom? And what if the top is in place and we're going to have a massive crash of another 1% or so? Well, the initial signal for that will be if we take out Thursday's cash session low right here. And I have put that in the report on the website. Okay, let's take a look at the NDX. And all of the indices are in the same phase of development. Now, this is the NDX is a fraction from an all-time high. This is the upper key reference area, which is basically Friday's high. And then the lower key reference area is Thursday's low. Pretty simple. And let's look at the Dow because I want to spend a little bit of time on the Russell. The Dow is trading in new all-time highs. We closed Friday. The Dow is a little bit of a divergence at the moment with the Dow leading the charge higher. There is no quote unquote resistance above Friday's high. There's nothing above there. The Dow was never traded in that territory. So there's no resistance. There's no previous price trade to give you some sort of clue. To the downside, something could be developing short term as a blip to the downside, at least below 37.051. Now, this structure is about as vertical as you're ever going to see a market get in this time frame. I put in the report, it looks a little bit like soybeans in a summer drought. It's just vertical. The rate of change for this market and the momentum off the October low that was confirmed by the ramp following the Fed meeting and the Fed speak and the reaction to it, that suggested that the market ultimately has a really good chance of going a whole lot higher. Now, it's tough to make that call when we're in dire need and we're going to get some sort of retracement at some point, but you don't really know when. The first signal of that, again, would be if we take out Thursday's cash session lows. But we are way behind in terms of pushing the envelope with a lack of development in here. And the Dow is the poster child for that at the moment. Okay, the Russell. Now, the Russell to me is often the most important chart because it is the index of the greatest number of stocks. It tends to be more reflective of the general health of the economy. And the Russell has screamed up into this extraordinarily well-defined peak here, extreme of a balance area. You have a balance area between this level here and this level down here. If you can visualize a profile chart, this is all a market profile. We are testing the upper extreme. This is a market that if we are going to have a bull run, if 2024 is going to be bullish, this is a market you may well want to look to for longs. So we'll see. But it's like the others, it is up a tremendous amount in a short period of time, and some development, some rotation on a day-to-day basis is increasingly overdue. Now, let me go over here to the report and take a look, and there are a couple of things I wanted to show. Well, let's start here. All right, I'm going to come back to this. And let me find, where's the one I want? Here we go. Okay, what you see here, this is the market profile of the SPX. Each profile is 1 day of trade, one cash session day of trade. Doesn't include Globex, as does the futures. And you can see here, this is Thursday's trade that includes the high of the rally so far, and this is some digestion going on. This is Friday's trades. You can see these closes are right on top of each other. Now, the reality is this is all one auction. And what that does, it enables us to identify very, very clearly the important 3 key reference areas that all balance areas contain: an upper extreme, a lower extreme, and a high volume node. You can see we closed right at the high volume node of this structure on Friday. And again, that was right at Thursday's close as well. So the market deemed this as an important level. Now, another note, Friday was triple witching expiration. So how real Friday's trade was and what it meant and its implications are yet to be determined, because you have all sorts of machinations with an option expiration as large as we had on Friday. That will carry over into Monday as rebalancing and hedging takes place. Now, to keep it simple, if the SPX on Monday or Tuesday takes out this high and it continues higher, then, and I'm going to get into some other things that might give us some shorter term projections. You can go long. That's an initiative situation. Personally, I'm not going to chase a market that is up this much. So I'm not really interested in the long side of this market at this point in time. And in the interest of full disclosure, I've been saying this for 2 weeks, so I've missed a really, really nice move, but I'm not going to start now. Okay, so if we do take this high out, and then if we were then to reverse and trade below the high volume node at 47.14, it's a sell signal against whatever high is put in place. If we take out Thursday session low, it's a sell signal against the upper extreme of this high volume node. I mean, that is about as simple and as rote as you can make it. Now, if you're an intraday trader, you can fine tune that to your heart's desire, but those are your parameters. Okay, let's see what else we have here. Let me scroll down the report. Again, you can download the report from the website. Okay, let's go to this view. Okay, what is this? This is the 30-minute SPX, and below it is NYSE breadth. And these annotations are highlighting the momentum peaks in the rally. This is the 1027 low from where this rally launched. And then we've had these momentum peaks. Here was one, here was one, here was one, and here's the latest one. And there's somewhat of a symmetry in play here. And what I have done, there's a number of ways you can slice this out. This is just one way. I have taken the momentum peaks, and then I have found, and then what has happened, and this is typical in bull legs. This is typical in the price breadth relationship between the SPX and breadth in bull legs. Bear legs, it's a different animal, but we're in a bull leg. So you have a momentum peak, and then you have breadth that will contract to one degree or another. This is a buy band. It's sort of a arbitrary. I'll let the market determine what it is. But you can see, beginning with this the October 27th low, every time we've come down into this area, you've had lows form. And ultimately, you've had a huge bungee jump to new highs from this area. The retracements so far you can see here have been extremely minor. In this leg, 1.02%, this leg, 1.01%, and in this leg, 1.09%. Now, I want to, I have, what I have done here, I have highlighted, I have gone from momentum peak high to momentum peak high. Now, the momentum peak is not the absolute price peak of these legs. It is the momentum peak as measured by an extreme in NYSE breadth, okay? So typically what will happen, you will set a momentum peak, price will work that off by going net sideways, and this has been an extraordinarily strong market, because you will quite often get deeper retracements against the price high than we've seen so far. But from momentum peak to the latest momentum peak, this one was 3.4% higher into the next momentum peak following balance. And then this one was 2.1% higher from the price high here of the momentum peak price high. And then this last one, this is you can't really read it, but trust me on this, it's 2.53%. Now, you will also notice that these momentum peaks, once the momentum peak hits, there typically occurs a sideways balance area type of movement that includes some sort of retracement. Now, this one doesn't fit yet. And again, we had option expiration on Friday, so I'm not sure. We closed down in the, we traded into this buy band essentially, but we really haven't spent much time off of this momentum peak that occurred on Thursday. This is Friday's trade. This was the momentum peak that occurred on Thursday. So I'm not sure what we're going to see. We'll probably know by Monday. And as I put in the report, we'll update this every night for members in the member section. But it's going to be really interesting to see how the market deals with what has been this little cyclic pattern between price and breadth in the bull leg that began at the end of October, and it has so far continued. But it's something has to give here, because once again, price and breadth are out of sync. We're sitting right at highs for the rally, with breadth being negative. Now, that was a situation over here too. And I sent out a report saying something had to change. We were on the cusp of a very sharp move. Sharp move was up. Well, we're in a similar situation here, but I don't see that exogenous catalyst that ignited this strong rally last Wednesday. So we'll see how that plays out. Okay, let's see. I think that's pretty much it, guys. So next week is going to be, as usual, interesting. We are in a seasonally strong period of year. Volume can start to tail off. Volume can be spotty intraday. The bias of this market is up. Be patient, be disciplined. I hope you have found value in this. And if you did, again, please like, subscribe, go to the website, check out my work there. You guys enjoy the rest of your weekend.